Buying a home is probably one of the most emotional and one of the most expensive purchases you will make in your lifetime. The coronavirus has brought a lot of hardship to American families. But surprisingly, we have seen an exponential boom in the real estate industry. This is why we now find ourselves in a seller's market. Real estate is controlled by the market forces of demand and supply. We have too many people looking for homes than there are existing homes. I speak, for example, like in the Houston market. In order for you to get a shot at a house as it's listed now, you have to pay more than the asking price. Usually when we set out to look for a home, excitement overrides reality. But one thing you should know, that drive-through, the nice curb appeal, the nice countertop becomes an illusion if you do not match value and comfort. This is why about 50% of Americans, they suffer what we call buyer remorse. They regret after moving into the home. Our topic for today is very important. 10 first-time home buyer mistakes and how to overcome them. Problem number 1, looking for a home before applying for a mortgage. What happens here is that we get too excited and we start going on the computer and the internet looking at all these fancy homes. We go tall model homes and we see all these wonderful stage, magnificent structures, and we get emotionally attached to them. And when we find out we are not able to qualify for a home of that nature, we do everything in our capacity to get that home because of that emotional attachment. What you should do is the reverse. Sit down with a mortgage broker or a loan officer. They will help you determine your debt to income ratio, what we call your DTI. Looking at your assets and your liabilities and determining how much house you can qualify for. They will provide you with a pre-approval letter. And the pre-approval letter is the first step because it clears two things. Number 1, it tells you exactly how much house you can qualify for. And number 2, if you set out today and you see a beautiful home and you like that home, you can't do nothing about it because the seller must see that you have a lender that is ready to provide you the funds. If you don't have a mortgage broker or a loan officer around you, you can use a Mortgage Affordability Calculator. I will make sure I include the link on this video. You can go there, put your income, put your credit card you put, and it's going to spill you out and tell you how much house you can qualify for. Talking to just one lender. Statistics have shown that first-time home buyers, they stick with the first lender they talk to. Compare a house purchase like any other expensive purchase. A car, a boat. How come you shop for these other items, electronics, but when it comes to a house, you don't shop? Because there's a myth outside which says when you shop with many lenders, it is affecting your credit. That is not true. According to the Mortgage Banker Association, multiple mortgage applications done within 45 days count as one inquiry to the credit bureau. Let's debunk that myth today. Compare 3 different lenders when you're about to purchase a home. Compare their rates, their lender fees, loan terms, and their closing costs. You can always start with your bank and make sure to always use mortgage brokers. I'll tell you why. Banks lend their own money. So they lend their own money on their own terms. So sometimes it could be very rigid because the loan officers who work at the bank, they work for a salary. A mortgage broker has a relationship with so many lenders, including banks. So depending on your situation, a mortgage broker will know where to channel your application. And because they do not work on a salary, they work on a commission. So they will do everything possible to push your loan to go through. Because if they don't get the loan, you don't get paid. At the bank, they're on salary. It's all about the laws. They tell you this is what the law says, and that's it. So I've seen many situations with some of my clients where we're working with the bank and working with a mortgage broker. At the end of the day, because of one thing, the bank declined the loan. But guess what? The mortgage broker steps in and we are able to close. Not checking credit reports and correcting errors. One of the big mistakes with most first-time home buyers. Errors on your credit report will lead to higher interest rates, and that will translate to thousands and thousands of dollars you're paying over the life of your loan. According to the Fair Credit Reporting Act, you have the right to dispute items that are on your credit. But most of the times, first-time home buyers don't understand this process. They are not patient enough. They are too emotional and too excited. They just want to get the house at all costs. What are some of the common errors on your credit report? Sometimes even the spelling of your name could be wrong. You may have small collection accounts, maybe cable bill, cell phone bill for $30, $40, $50, but they're in collections and they are hurting your credit. Most of the times, people also find out that they have wrong inquiries. What about in case of identity theft and somebody was trying to use your card or your social security somewhere to obtain stuff and you don't even know? Those things, they affect you. Outdated information. According to the Fair Credit Reporting Act, any account that has been on your credit on a creditor for 7 years, the statute of limitation is 7 years. After 7 years, that account is supposed to drop automatically off your credit. But if you don't check your credit, how would you know? How would you take out those outdated information? Sometimes some people find out that their ex-spouse is still listed on their accounts and it is hurting them. How would you know? You may also have a wrong address listed for you, or they have addresses listed for you that you never live in those addresses. They are affecting you. Each year, every citizen is entitled to get a free copy of your credit report from all 3 credit bureaus: Equifax, TransUnion, Experian. Go to annualcreditreport.com. I will make sure I include that link on this video and get a free copy of your credit. Take your time, see what's in the credit. Look at the items that are mistakes, the ones that you can dispute, and make sure you take care of them in time. This will help you a lot in determining your interest rate. Don't just be in a mad rush to, I must get this house, I must get this house. Take time and see what's on your credit, and you will be surprised at some of the things you may find on your credit and how easy it is for you to be able to take care of them. Now, if you find out that you have so many stuff on your credit, then there are so many companies out there doing an incredible job with credit repair. Number 4, moving too fast. This is very important. Rushing can cost you a lot later. There are some little things that if you had been a little bit patient and planned a little bit more, you buy correctly. If you're rushing, you would not have time to fix errors on your credit report and to paying down your debts. Because when you pay down your debts, then you get a low debt to income ratio, which would translate to a low interest rate, which would further translate to a low monthly payment. Give yourself 12 months to plan and save for your down payment, closing costs, and other related costs. As part of your plan, I advise you 12 months in advance to sit with a loan officer and determine what your options are. And both of you can come out with a plan. And during the 12-month period, you can follow that plan and make sure that you are not just buying, but you are buying correctly. People who do their homework are always very happy because you will be able to match comfort and value. Because value is the appreciation that you get for the home over time. And comfort are the aesthetics, the marble floor, the granite countertops. All those things will wear out with time, but the value of the home will be what will make you comfortable and build equity, drowning your savings for a bigger down payment. Whenever you're purchasing a home and you're putting down less than 20% of the value of the loan, the seller imposes what we call a private mortgage insurance. We call it PMI. This is a way for them to manage their risk in case you default. If you can afford to put down 20%, then there is no PMI. PMI sometimes could mean a lot when it comes to your mortgage payments. PMI for an FHA loan will stay with the life of the loan. For a conventional loan, the PMI will drop once you get to that 20% margin of your loan value. I've seen so many cases where people have conventional loans. They bought their home maybe with 5%, 10%. They have paid more than 20% of the value of the loan, and they don't even know that they have to call the mortgage company to drop the PMI. Sometimes the mortgage company will do it automatically, but sometimes you will have to call them for them to be able to take that off. So the mistake most first-time home buyers make is drowning all of their savings because they want to avoid the PMI if it's not worth it. Because I've seen cases where couples drown all of their savings, buy home, they get into the home, buyer remorse sets in, regret sets in, and they start quarreling. You want to be comfortable and happy when you get into your home. That is why it's always advisable to save at least 3 to 6 months of your living expenses to avoid any buyer remorse. First-time home buyers, most of the time, do not research on available down payment assistance programs. Some down payment assistance programs are federal, and we also have state programs, depending on where you live. I will make sure I include the link to the down payment assistance program state by state. So wherever you find yourself, you can just go in there and click in there and see the programs that are available for you. Sometimes some counties also have down payment assistance programs. So you need to do your research. Depending on where you're buying sometimes, you may have a U.S. Department of Agricultural loan, USDA loan, which is a zero down payment loan because it's encouraging people to build in a particular locality. There's a VA loan, zero down payment as well, if you're a veteran. Then there's a FHA loan, Federal Housing Administration loan, a credit score of like 580, and as low as 3.5%, you can get a home. There are some conventional loans where you can pay as low as 3% of your down payment. In Texas, for example, we have the HEROES Down Payment Assistance Program. And this is typically for teachers, firefighters, police officers, people who are in the medical field, and first responders. Spend some time, research on what opportunities may be available for you in your state, sometimes in your county. Not knowing when to buy loan discount points. Most of the times, the lender will tell you, the first-time home buyer, that you can buy down your interest rate in order to lower your down payments. So loan discount points are fees to reduce your interest rate. The key is in you knowing how, when, and whether you should buy loan discount points. And the only way you will do that is by calculating your break-even point. Break-even point is the point when you must have paid off the amount you use to buy the loan discount points. That is when you'll be able to see some kind of savings. Let's say, for example, you have a loan for $200,000 at 4.1 interest rate. Your principal and your interest is $957 a month. You spend $2,000 and you buy down 1 point. Your interest rate is now at 3.875. Your principal and your interest will be $938. This translates to a $19 a month savings for you. How do you determine your break-even point? Let's say, for example, your loan costs $200,000 at an interest rate of 4.1%. Your principal and your interest will be $957 a month. Let's say you buy down 1 point and it costs you $2,000 to buy down 1 point. Your interest rate is now 3.875%. Your principal and your interest is $938. This translates to a $19 a month savings. In order to determine your break-even point, you would divide the cost of the discount divided by the amount of your monthly savings, which is 19, and this will give you $105 a month. $105 a month. How long will it take you for you to be able to pay off this $2,000? It will take you approximately 8.8 years. So we can round it up to 9 years. After 9 years, that is when you must have paid off this initial amount of $2,000 and start enjoying the real savings of $19 a month. Now, what if interest rate drops as they're dropping now and you want to refinance that house? Would this make sense? $19 a month. If you calculate inflation and the effect of taxes, is it worth it? So be careful when lenders throw out this nice looking juicy cake here. Sometimes when they tell you you can buy that 1 point, you even tell them, can I buy 2 points? Be careful. Make sure you know when and how this will affect you and when you'll be able to reach your break-even point. It's the key. Fixating on house and not the neighborhood. It goes back to my opening statement. Getting an emotional connection with a house. Sometimes when you're going out to look for homes, you have a checklist and you've seen this house that meets all of your criteria. The next thing you need to check is the neighborhood. And even when we find out that the neighborhood does not have the values that we want, we still want to push ahead and buy this house because of this emotional attachment to that house. Real estate, like I said on my last video, is location, and is location. And if you don't do it right, you will not be happy. There are some things you can trade about a house. You can trade off not having a third bathroom. You can trade off not having a formal dining. You can trade off the house not being in a cul-de-sac. But you can never trade location. Never. Because that's where the value of your house is hanging on. Get a real estate agent. Real estate is local. Get a real estate agent who understands that local market environment so they can give you statistics on the crime rate, the schools, the commute. If I were you, I will also drive to that area on different hours, times of the day and get a vibe of how that neighborhood is doing. Don't just rely on your checklist because this house meets all of your criteria and you are bent and you must buy the house. Underestimating the hidden cost of home ownership. Most people look at just the mortgage when they're buying a home. When they get into that home, they found out it was just not about the mortgage. So many other things come in play. You have to deal with lawn care, replacing filters, homeowners association fees. They are mandatory. Sometimes it's always good if you're buying an old house to ask for a copy of the seller's utility bills. That will help you give you an idea of what the utility bills are. Property taxes is another thing. Homeowner insurance, what we call hazard insurance. I always advise when you're buying a home, talk to your auto insurance company because in that case, they are just adding you another line of insurance. They're not giving you a new insurance policy and it's usually come out to be very, very cheap for you. Property taxes, depending on the area where you live. Some areas have very low tax rate and some areas have very high tax rates. If you're buying a new home, make sure you pay improved value from day one. Because if you don't do that, then sometime down the line, you'll be surprised by this huge tax bill. Because when you buy a new home, it is just the value of the land that you're paying taxes for. In a year and a half after, when the county come and assess the property, you'll get a new heavy tax bill. Ask the lender, I want to pay an estimated improved tax value from day one to avoid any surprises. If you find yourself in a municipal utility district, what we call a MUD district, there's a tax for that. What is a MUD district? Sometimes the city limits may not have extended utilities to certain new communities. So the community, they have what we call a MUD tax to take care of their water, their sewage, and all of that. And it is a tax that is paid by all members of that community. So make sure you find out, are you in a mud district? Because that's extra money. School taxes, you have to pay. Unexpected repairs, it is normal with home ownership. Make sure you understand the hidden cost and do not be surprised. A big mistake by most first-time home buyers. Not hiring a real estate agent. I see first-time home buyers all of the time make the mistake, especially when they're buying a new home from a builder. When they go to the builder will present them two offers. This house will cost you $200,000 if you don't have an agent. The same house will cost you $210,000 if you have an agent. And most of the time, by nature, we like the cheap offer. We fall for the offer without an agent. But my question to you is, what do you understand by a comparative market analysis? How do you know if the house is overpriced or not? What do you understand by appraisals, inspection points, loan amortization schedule, loan origination points, loan origination fees, municipal utility districts, crime rate, home appreciation, homestead exemption? What do you understand about these terms? You have no idea what they mean. The builder's agent is in the best interest to represent the interest of the builder and not you. A real estate agent has a fiduciary duty to represent you, to work for your interest. The seller pays the real estate agent to work for you for free. So why not use one? Why fall for the dirty tricks that the builders will sometimes give to you? I've seen so many cases where people end up losing their house because they did not understand improved versus unimproved home values. And later, when their home is assessed by the county, they now get a new bill in the mail. Instead of paying $1,000, your mortgage has now jumped up to $1,700 to $1,800. It is not in the builder's interest or their duty to educate you. You as a buyer must do your due diligence. Real estate professionals they understand and know the local market and are ready to serve you. But my caution to you is, make sure you hire the right agent. Don't just hire an agent who is there just for a sale. Make sure you have an agent who thinks beyond money to your well-being. Make sure you hire a real estate agent and make sure you hire the right agent. C2C Mentors is a real estate mentorship community. And all we do here is talk about your finances. We talk real estate because we understand it is at the foundation for your family's success. See you on our next video.